Now we're going to look at 5. It doesn't look like there was any beginning inventory. 80 units, 420 units, 250 units, 150 units at $15, $16, $20, $22, and of course the dates they were purchased. And these are the 4 different inventory layers. Layer 1, Layer 2, Layer 3, Layer 4. So we know we bought 900 units. And we also know, excuse me, we also know we sold 830 units at $40 each. So what we're going to do here is we're going to look at this from a FIFO and LIFO and weighted average perspective. The first one is FIFO. Now what they're doing is they're doing this backwards from previously. And how they're doing it backwards is they're determining what the value of the ending inventory was, and then they're determining what the cost of goods sold is. So FIFO, first in, first out. So we purchased 900 units throughout the year, available for sale 900 units, and we sold 830. So what happens is we took 80 units out of the January 20th purchase, 420 units out of the April 21st, 250 units out of the July 25th, and then we took 80 units, it looks like, out of this right here. And that, out of the 150 units, we sold 80 at cost of goods sold $22, and we had 70 remaining units because first in, first out. So we go through the first 3 layers, then we take what we need out of the 4th layer, and we're left with inventory from the 4th layer right here, 70 units at $22. So this is our ending inventory, $1,540. So now what we need to do is we need to look at how we're going to determine our cost of goods sold. We're going to stick with FIFO for a minute. So we know our total cost of goods sold is $16,220, but we didn't sell all of it. We know we ended up with $1,540 right here, and that means $14,680. So if we go down here to $14,680, that's our cost of goods sold in here. Just give me a second. Okay, that's off of the weighted average. Yes, right here. FIFO, sales, 830 units at $40, $33,200. 830 at $40 a unit. Cost of goods sold, again, we started with $16,220. We had ending inventory of $1,540. That's how we determined our cost of goods sold is $14,680. So that's how to do that for the FIFO. Then in this section here, I did most of the journal entries for you, but you're going to have to probably close them out. So we want to look at FIFO now, excuse me, LIFO. Give me a second, please. All right, now we're going to look at LIFO. LIFO. So what happened was we have, if you notice, we ended with 70 units as well at $15. So with LIFO, you use the most recent, last in, first out. So you used 150 units, purchased September 19th, used the 250 units, purchased July 25th, used the 420 units on April 21st, and then you only took 70 out of the 80 units purchased January 20th at $15. Oh, excuse me, you only took 10 out of the you took 10 out of the 120 units. But 10 out of the 80 units. So that means you're left with 70 units in ending inventory at $15 a unit, giving an ending inventory balance of $1,050. So again, we know that $16,220 is the total cost of inventory. We ended the inventory balance with 1050. Again, we started with the most recent inventory purchases and worked our way back. The ending inventory we use for cost is the first inventory we purchased. Again, we're using LIFO method, so it's the first inventory we purchased, that's what's left over. So now we're going to look at what this looks like on an income statement. These are the journal entries under FIFO. These are the journal entries under, general ledger. General journal right here under FIFO and LIFO. And now we're going to look at what it looks like in an income statement form for, here it is. Under LIFO method, 830 units at $40, $33,200, the same as under the FIFO method. Cost of goods sold, $16,220, just like the FIFO method. The ending inventory balance is different, $1,050, and the reason why is because we started with LIFO. The newest inventory costs first were used for cost of goods sold, and what the oldest inventory first in was used, was left over for inventory. So that's going to give us cost of goods sold $15,170. So $33,200 minus cost of goods sold right here is going to tell you what your gross margin is. Then we have to look at weighted average. And with weighted average, all you're doing is you're adding up, just like the previous one with weighted average, right here. You're adding up all these inventory items, a total cost of inventory, 16,000, and dividing it to 900. So that's what you're doing right there, and that is how to get through the exercise. Now, when you're going through the general journal, all you're doing is you're recording right here. The purchase entries are the same for all three methods. Okay, purchase entries are the same for all three methods. Merchandise inventory, $1,200, inventory went up, cash went down. You're just following all the transactions, the 4 transactions. And then you get to the journal entries right here, and what you're doing is sales, 33,000, and then you show the transactions. Cash went down and merchandise inventory went up. So cash is going down right here. You're crediting crediting cash on these right here, and you're debiting merchandise inventory. Cash goes up, cash is debited, sales revenue is credited. Then you got to figure out what cost of goods sold is. Okay, how much inventory goes down by, and how much cost of goods sold goes up by. And then you do the same for LIFO. So again, what you're doing is you're figuring out how much inventory was closed, how much you sold in inventory, and what your cost of goods sold is. That's how you close that one out. And the same for LIFO, and the same for weighted average. Weighted average, you just take the 900 units that you purchased, divide by the total cost of them, and that's going to give you the weighted average for each unit. And I think that that pretty much concludes it right here. Just spend a few minutes taking a look at this, and it should all make perfect sense. So again, please read Chapter 5 in depth, read the PowerPoints, watch all the videos I posted, and this should get you through it. And if you get stuck, you should be able to email me, post it in the discussion. If you post it in the class group work, that way everyone from the whole class can jump in and help you. But again, what we're doing right in your textbook is on page 272 and 273. So page 272, 273, and then of course on 275 is going to be the income statement. That's exactly what we're doing. All we're dealing is multiple layers with multiple quantities of inventory, multiple layers of inventory. So 272 through 275, if you read those 3 pages, this should make perfect sense to you. And 277 might help you as well. It will help you. But there are some really good exhibits in the textbook as well showing you. You know, for example, 277 in your textbook, Exhibit 5.3, inventory balance and cost of goods sold using a FIFO method. You know, it's going to show you what's happening as you're making purchases and sales. That may be a bit confusing, but more importantly, if you look at 272 through 275, you will be good to go. Any questions, let me know. Best of luck, and again, post any questions in the group work so we can jump in as a class and help you right away, and that way someone else can learn from this as well. Thank you.